Nothing can wreck your trades faster than emotions. Fear, greed, hope, regret. They can all wreak havoc on your trading. If you've spent any time in the markets, you already know that. But do you know what to do about it? In actuality, more traders encounter the drawbacks of trading psychology than the benefits. Examples of this include hastily exiting losing trades, as the fear of loss becomes overwhelming, and doubling down on losing positions, as the fear of incurring a loss transforms into greed. Before continuing, if you are new to the channel, don't forget to hit the bell button and subscribe, so you won't miss any of the next videos we release. Trading psychology examines the psychological and emotional states of traders. It all comes down to how your actions and outlook affect your trading. Your self-control and risk-taking are also mentioned. Your capacity for long-term trading success greatly depends on your thoughts. Understanding your trading philosophy can be just as crucial as honing your stock market talents. Here are some guides on how to master your mind when trading. I'll also go over some typical mistakes to watch out for and actions you may take to stay focused on the task at hand. 1. Practice with a paper trading account. What is paper trading? Paper trade is a simulated trade that allows a trader to practice buying and selling without risking real money. It helps new traders by allowing them to practice important risk-taking procedures, from the choice of stocks to the final departure. But the method has limited effectiveness because it downplays the importance of index correlation and emotional responses in a real market day. Learning day trading requires both talent and knowledge as well as experience and practice. A paper trading account can assist you in learning the trading platform and the procedure for analyzing and carrying out trades. If you are a novice trader, use it to practice utilizing stop losses and limit orders. By the way, not only is paper trading for new traders, it's a useful resource to refer to as your abilities develop and change. You can make use of it to test out a risky transaction or a technique that you aren't yet ready to wager real money on. 2. Assume your first losses as a fee for learning. There's nothing quite like jumping into a live account, even after months of practice. When one of your holdings starts to decline, you can become anxious and abandon a position too soon. When it returns to your original goal a few hours later, you'll then kick yourself. Or, out of greed, you could cling to a position for too long, hoping to get a bit more, and you'll disregard all warning signs. Remember, all traders go through this phase. Your trading emotions may get volatile if you use real money. It's just normal. There is now actual money at stake. So, consider your initial losses to be the cost of doing business. All of it contributes to your trading education. 3. Observe the habits of successful traders. Successful traders avoid developing an emotional attachment to the markets. Instead, they learn from other traders who are successful and ahead of them. No need to create anything entirely new. Instead, take advice from the profitable traders who came before you. Learning from seasoned traders is now simpler than ever. You can find some free and no-cost resources that can help you trade better and profitably, like our channel. Top traders devote effort to learning the fundamentals. Then they put forth effort to continue learning and conducting research. They keep expanding and everyday scan stocks. They most critically set objectives. They examine their methodology, trading, mindset, and advancement. Yes, they err, but they grow from them and get better. Proactive traders perform better than reactive ones. Instead of concentrating on the result, such as how much money they might make, they concentrate on the process of identifying excellent market prospects. Read trading manuals with back-tested performance and put the trading plan into practice. Model consistent profitable traders. 4. Set stop losses to protect your account. No way it could get any worse, right? Keep these phrases in mind as you observe the point-by-point decline of your favorite stock. You'll cling to hope despite all odds, many degrees of support, and various levels of support. You can't force the market to go your way. It can and frequently does things you wouldn't anticipate. It could appear to defy logic and all that you've learned. Accept that the market is a random place. Some market waves are simply too powerful to surf. Learn to cut your losses as they occur and flow with the situation. Keep your stop losses at a distance that will prevent you from being forced out of a position by a slight dip. Additionally, a stop loss needs to be sufficiently tight so that you can sell as soon as something doesn't go according to plan. Quickly cut your losses to maintain your trading psychology. 5. Choose your favorite patterns and stick to them. A significant component of trading psychology is pattern recognition. Recognizing patterns might benefit you in your trading because they frequently repeat. However, you must find what functions for you. Choose 2 to 5 of your top choices. Learn to spot them when they happen. You can as well keep charts and binders so you can study them whenever you need to. Everyone has a favorite chart pattern that they feel works the best for them, such as head and shoulders or cup and handle. 6. Learn how to properly read news catalyst. When most individuals read a news article, they expect that it will act as a trigger. But by the time you read that news, every other trader has already done so. They have already taken action on it. The same catalyst may lead several stocks in the same industry to rise, but perhaps there is one that is still behind that you can get on. The alternative is a better strategy. Check out stocks first using a stock screener. Next, search for a news story that can be used to explain a stock's performance. Even with the best technical analysis, if news catalysts aren't taken into consideration, you could still lose money. 7. Use a stock screener to locate your best stocks to trade. It is not easy to choose the greatest stocks, there are tons of them. It's challenging to follow the daily performance of several equities. So, how do you surf through mountains of data to locate the information that will help you? You can narrow your focus to stocks that fit your needs by using a watch list. Depending on your approach, you can establish your own parameters for the categories of equities you want to track. Stock screeners can help you identify the companies you wish to trade. By sorting through thousands of stocks, you can then concentrate on those who meet your requirements. Although stock screeners are a great place to start, they do not provide you with all the information. To find out if there are any business-specific challenges, such as labor disputes or lawsuits, you'll need to do extra investigation. Conclusion: while many traders invest a lot of effort in creating trading systems, these tools are only as good as the traders who employ them. Trading psychology is enhanced by focusing on you, the one who pulls all the triggers and makes all the trading decisions. If you want to succeed over the long run, you must focus on the mental game. That's all for today's video. Guys, tell us your views in the comment section, and if you're new to the channel, don't forget to subscribe. Thank you very much for taking the time to watch this video. See you in the next video. Cheers.